February 5th, 2018, 4:15 p.m. Eastern Time. The market had already closed, but something catastrophic was unfolding in after-hours trading. The VIX, Wall Street's fear gauge, had spiked above 50, more than doubling in a single session. In those frantic minutes, a financial product that had delivered steady profits for years began its death spiral. The Quarantine Exchange traded note, holding $1.9 billion in assets just hours earlier, was collapsing in real time. Retail investors watching their screens saw prices in the 80s and bought frantically, desperate to catch what looked like a discount. They didn't know the true value had already fallen to $4. By morning, Credit Suisse would declare the product dead, triggering an acceleration event that vaporized 96% of its value overnight. Approximately $700 million transferred from panicked retail buyers to sophisticated sellers who understood what was happening. This wasn't a random crash. It was the predictable endpoint of a 5-stage pattern, a structural sequence that transforms market calm into catastrophic implosion. That pattern didn't disappear after 2018. It migrated. The same mechanical forces, the same psychological traps, the same mathematical inevitabilities are rebuilding right now in 2025. Different products, identical structure. The snake is eating its tail again, and most investors have no idea they're inside the sequence. This is how ETF markets fail, why the pattern repeats, and why the early stages are already visible. The Volmageddon collapse of February 2018 wasn't caused by an external shock. It was a structural implosion, engineered over years of extraordinary market tranquility. The stage was set during the prolonged period following the Great Recession, when the VIX settled into historically low ranges. By November 2017, it had reached an all-time low of 9.12. This number represented deep market complacency, an assumption that volatility itself had been tamed. That assumption made one trade immensely profitable, shorting VIX futures. These contracts typically trade in contango, where contracts expiring further out in time cost more than near-term contracts. An investor betting that volatility would stay low could profit systematically from this price structure. Each day, as higher-priced future contracts rolled toward expiration, they decayed in value. This daily roll-down delivered robust returns with apparent consistency. Over $5 billion flowed into strategies designed to capture this decay. The trade wasn't limited to sophisticated hedge funds. Exchange-traded products made it accessible to common investors who had no understanding of the derivative mechanics underneath. Products like the Velocity Shares Daily Inverse VIX. Short-term ETN allowed retail traders to bet against market fear with a simple ticker symbol. The concentration of capital in this single strategy created a structural monoculture. Institutional desks, proprietary trading, firms and retail accounts all crowded into the same position. They were betting not that markets would rise, but simply that volatility would stay suppressed. The distinction matters because it meant the trade could fail even without a major equity decline. A volatility spike alone would be sufficient. The psychology driving this convergence was hubris. Extended success creates dangerous overconfidence. Historical patterns confirm that bull markets breed the belief that participants have discovered a permanent edge, that they're capable of extracting consistent profits without corresponding risk. Volatility was no longer treated as a measure of uncertainty, but as a tradable asset delivering predictable income. This belief was codified in sophisticated financial engineering. The products treating volatility as an income source ignored a fundamental reality. Volatility reverts violently. When markets exhibit prolonged stability, the mechanism of market discipline recedes. Risk management softens. Hedging seems unnecessary. The low volatility environment wasn't evidence of fundamental strength. It masked dangerous accumulations of unhedged exposure, amplified by collective behavioral convergence. The structural flaw at the heart of the short volatility trade was its self-referential nature. The scale of the strategy became so massive, estimated to influence over $2 trillion in related positions globally, that it began impacting the volatility it was designed to track. Analysts warned explicitly about this feedback loop, using the metaphor of the Ouroboros, the ancient symbol of a snake consuming its own tail. The dynamic worked like this. Low volatility encouraged more short volatility positions, which suppressed volatility further by providing constant selling pressure on VIX futures. This created a self-perpetuating cycle, pushing variance toward zero. But the cycle contained its own destruction. The warning was clear. The multi-trillion-dollar short volatility trade would contribute to a violent feedback loop where rising volatility triggered forced buying, which drove volatility higher, creating a hypercrash with no theoretical limit on how high the VIX could spike. The snake would die from consuming itself. The mechanism translating this dynamic into financial ruin was the structured product design. The Quintian and similar products were built with daily rebalancing mandates. Each day, they had to adjust their positions to maintain their stated inverse exposure to the VIX index. This wasn't discretionary, it was contractually required. When the VIX surged, the product's underlying capital base shrank rapidly. To maintain the inverse exposure relative to this smaller base, they were mechanically forced to cover their short positions by buying VIX futures. The larger the VIX move, the larger the required buying. This created a deterministic amplification mechanism, rising volatility forced buying, which pushed volatility higher, which forced more buying. Prior to the collapse, Quintian and its peer SVXY held approximately 280,000 VIX futures combined, representing roughly $280 million in short Vega exposure. When the rebalancing requirement triggered, this massive buying hit a market already experiencing stress. The products designed to track volatility became the primary drivers of the volatility spike that killed them. This wasn't a bug in the system. It was the system operating exactly as designed under stress conditions. The daily rebalancing mandate transformed a routine market dip into a catastrophic liquidation event where the tail wagged the dog. The mechanical destruction was amplified by a hidden mathematical peril embedded in the product structure: compounding decay. Leveraged and inverse ETPs are designed to achieve their stated performance objectives on a daily basis only. They reset each day. This daily reset mandate harbors devastating consequences when markets are volatile. Consider a simple example. An underlying index starts at 100, rises 10% to 110, then falls 10% to 99. The index has lost 1% overall, but a corresponding 3x inverse ETF suffers far worse. Starting at $100, it loses 30% on day 1, falling to $70. On day 2, it gains 30%, rising to $91. The cumulative loss is 9%, 9 times worse than the underlying index, despite tracking it inversely. This isn't a mistake or miscalculation, it's guaranteed mathematics. The daily reset means gains and losses compound asymmetrically. In volatile or choppy markets, even if the underlying index returns to its starting point, the leveraged product loses value. The decay accelerates with leverage and volatility. This made leveraged inverse volatility products fundamentally unsuitable for buy-and-hold investors. Yet regulatory disclosures, while technically accurate, proved insufficient to prevent widespread misuse. The products generated high expense ratios, creating powerful financial incentives for issuers and distributors to maximize assets under management. This incentive structure encouraged mass distribution of a complex derivative strategy to the least prepared investors. The product design also included a legal backstop for issuers. Credit Suisse's documentation for Warrant included an acceleration event clause. Once losses exceeded a certain threshold, the issuer could declare this event, liquidate the product, and transfer the final catastrophic loss to note holders. This contractual provision allowed the issuer to profit from the product for years during calm markets, then shield itself from tail risk via a predetermined escape clause. The moral hazard was profound. The people creating and distributing the product knew the failure mode was catastrophic. They knew the daily rebalancing mandate would amplify any volatility spike. They knew retail investors holding these products long-term faced mathematical certainty of decay during volatile periods. Yet distribution continued because the fee income was substantial and the contractual language provided legal protection. On Monday, February 5th, 2018, the structural weaknesses and psychological complacency converged. The Dow Jones Industrial Average plunged 1,075 points, its largest one-day point decline in history at that time. This equity drop activated the mechanical failure sequence. The VIX reacted with unusual behavior. During the first part of the trading day, its movement was muted. Then it accelerated rapidly toward the close, vaulting 115% from the previous close of 17.31 to settle at 37.32. The critical moment came in after-hours trading when the VIX spiked above 50. This after-hours spike was determinative. It locked in maximum losses for the inverse VIX products before they could execute their mandated rebalancing. The timing was catastrophic because it occurred during an illiquid trading window when fewer market participants were active and price discovery mechanisms were weakened. The simultaneous execution of mandated buy orders by collapsing ETPs collided with a critical failure in liquidity provision. Financial crises are characterized by sharp reductions in liquidity as participants facing large losses also hoard cash rather than stepping in to buy falling assets. In this scenario, the forced buying of VIX futures flooded an already spiking market. High-frequency trading algorithms that typically provide market efficiency began amplifying the sell-off instead. The market maker community handling VIX futures liquidity faced overwhelming losses. When dominant liquidity providers widen quotes or withdraw entirely, it triggers follow-on effects from others. The result was an accelerating decline in equities and a non-linear spike in volatility, transforming a routine dip into a technical, structure-driven collapse. The velocity of wealth destruction was staggering. Omkin, starting the week with $1.9 billion in assets and trading near $100 per share, saw its value plummet 96% in after-hours trading, settling near $4.22. The following morning, Credit Suisse declared the acceleration event and announced liquidation. Approximately $3 billion in value vaporized in that single day. But the acute moral dimension centered on the trading that occurred immediately after the 400 p.m. close. Credit Suisse was obligated to publish real-time estimates of the note's economic value based on VIX futures prices. Lawsuits later alleged a massive failure in information integrity. Credit Suisse effectively stopped updating accurate estimates around 4:10 p.m., just as VIX futures were spiking significantly. Sophisticated market participants understood the redemption value had collapsed to approximately $4.22 to $4.40 per share, but publicly quoted prices remained inflated, trading as high as the 80 Zellers. Retail investors operating under extreme panic and suffering profound information asymmetry bought approximately 28.8 million shares after 4:15 p.m. at an average price of $28.60. This aftermarket activity resulted in an alleged transfer of roughly $700 million from unsophisticated buyers to sellers offloading risk. This transformed the event from a financial loss into a profound breach of market integrity, where information failure translated directly into exploitation of panic and rapid wealth transfer. The Volmageddon collapse followed a predictable 5-stage sequence that defines ETF structural failures. Understanding this pattern is critical because it's repeating now in 2025. Stage 1, calm breeds crowding. Extended periods of low volatility or steady market conditions attract capital to strategies exploiting that calm. The VIX reaching historic lows encouraged massive inflows to short volatility products. The trade delivered consistent profits, which attracted more capital, creating concentration. Over $5 billion occupied the same structural position by early 2018. Stage 2. Leverage amplifies exposure. The concentrated position gets amplified through leverage and derivative structures. The inverse VIX products didn't just hold short positions, they used daily rebalancing to maintain leveraged exposure. This multiplied both returns during calm periods and losses during stress. The leverage ratios and daily reset mechanisms guaranteed that any significant volatility spike would trigger massive forced adjustments. Stage 3. The feedback trigger. A market event, often modest in isolation, triggers the mechanical unwinding. On February 5th, equity markets dropped sharply, but not catastrophically. However, this drop was sufficient to spike the VIX and activate the rebalancing mandates. The products were forced to buy VIX futures into a rising market, which pushed prices higher, triggering more forced buying. The feedback loop became self-sustaining. Stage 4. Liquidity vanishes. As forced selling or buying intensifies, liquidity providers withdraw. Market makers facing large losses widen spreads or step away entirely. High-frequency algorithms designed for normal conditions amplify rather than dampen price movements. The market structure that worked in calm conditions fails catastrophically under stress. The VIX spike accelerated precisely when liquidity was lowest, after hours, maximizing the damage. Stage 5. Forced liquidation and wealth transfer. The products collapse, triggering contractual termination clauses. Issuers liquidate positions, crystallizing losses. The final phase often involves significant wealth transfers from uninformed participants to sophisticated actors who understood the structural failure in progress. The $700 million aftermarket transfer exemplifies this stage. This 5-stage pattern isn't unique to inverse VIX products. It's a structural template describing how ETF markets fail when mechanical mandates collide with market stress and liquidity withdrawal. The specific products change. The pattern remains constant. The structural mechanisms causing Volmageddon didn't disappear. They migrated to new products and strategies. The post-2018 environment saw risk shift rapidly to emerging frontiers of leverage. The most prominent current manifestation is 0 days to expiry options, commonly called 0DTEs, on the S&P 500 index. These options expire on the day of trading, making them extremely sensitive to intraday price movements. They're attractive because they're relatively cheap and offer lottery-like payoff profiles with extremely high, albeit unlikely, returns. The leverage embedded in 0 DTEs can exceed 400x. A small movement in the underlying index generates massive percentage moves in option value. This creates the same psychological attraction that drove short volatility trades. The appearance of consistent, easy profits during calm periods. Capital has concentrated massively in these structures. Current analyst warnings point to record amounts of margin debt tied to crowded trades, particularly in artificial intelligence and technology stocks. The structural parallel to 2018 is exact. Concentrated positions, high leverage, daily settlement requirements, and forced adjustments when markets move. Should a single disappointing earnings report or economic data point trigger a sharp move, the combined layers of corporate debt funding growth and investor margin debt could trigger a margin-driven cascade. This would echo the exact mechanical failure of Volmageddon, forced selling amplifying price declines, which trigger more forced selling. The pattern has also appeared in fixed income ETF structures. Bond ETFs hold relatively illiquid underlying assets, corporate bonds that trade infrequently with wide bid-ask spreads. But the ETF shares themselves trade with stock-like speed and liquidity. This creates a structural mismatch. The creation and redemption mechanism involving authorized participants is designed to buffer this mismatch. APs can create or redeem ETF shares by exchanging them for baskets of underlying bonds, which should stabilize the ETF price relative to its net asset value. But this mechanism faces severe stress during market downturns. Large redemptions could overwhelm the AP buffer. If bond markets are already stressed, APs may widen quotes or withdraw, refusing to perform their stabilization function. This forces the ETF to transmit selling pressure directly to the underlying bond market, triggering fire sales where declining prices force additional liquidation. The feedback mechanism is identical to inverse VIX products, a structure designed for calm conditions that fails catastrophically under stress, with mechanical mandates amplifying rather than dampening volatility. Another structural vulnerability has emerged with semi-transparent and non-transparent active ETFs. These structures allow portfolio managers to withhold full daily disclosure of holdings, protecting proprietary strategies from front-running. But the core defense of the ETF model is the arbitrage mechanism performed by authorized participants. This arbitrage relies on knowing the exact composition of underlying holdings to calculate fair value and execute creation/redemption efficiently. Reduced transparency compromises this pricing integrity. If transparency is insufficient during market stress, APs cannot accurately price the ETF relative to its net asset value. This impairs their ability to stabilize prices through arbitrage. While non-transparent ETFs are currently limited mostly to domestic equities, the opacity injects risk by potentially weakening the mechanism designed to insulate ETF structures from panic selling. The pattern repeats because the underlying incentives and behavioral dynamics remain unchanged. Financial innovation continuously creates new ways to package leverage, offer seemingly easy returns, and distribute risk to participants who don't fully understand it. Regulatory responses after 2018 focused primarily on transparency and disclosure. The SEC and FINRA issued updated bulletins warning that leveraged and inverse ETFs are specialized products with extra risks for buy-and-hold investors. Credit Suisse included warnings that widening could lose all value during volatility spikes. But disclosure alone doesn't prevent structural failures. The incentive to distribute these products remains powerful because their complexity generates high fees. Issuers profit substantially during calm periods. Contractual clauses like acceleration events allow them to exit during catastrophic losses, transferring final risk to holders. The suitability gap persists. Complex derivative strategies accessible to common investors creates an inverse relationship between product complexity and investor sophistication. Written disclosure proves insufficient to counter the powerful incentive to chase returns, especially when those returns appear consistent over extended periods. The five-stage pattern doesn't require identical products. It requires identical structural conditions, concentration of capital in leveraged strategies, mechanical mandates that force buying or selling during stress, and liquidity withdrawal when participants face large losses. These conditions exist now in 2025. The concentration is in zero DTE options and margined technology positions. The mechanical mandates are daily option expiration and margin calls. The liquidity vulnerability is the record level of margin debt and the mismatch between liquid ETF wrappers and illiquid underlying bonds. The early stages of the pattern are visible. Capital is crowding into high-leverage strategies during a period of relative market calm. Participants believe they've found reliable excess returns. The feedback mechanisms are in place, waiting for a trigger. The trigger could be an earnings disappointment, an economic data surprise, a geopolitical shock, or simply the internal dynamics of overcrowding reaching critical mass. When stage 3 begins, when the feedback trigger activates. The progression to stages 4 and 5 accelerates rapidly. Volmageddon moved from routine market decline to complete product liquidation in hours. The Soviet Union collapsed in 900 days. The speed depends on the specific mechanics, but the inevitability is mathematical. Market discipline alone doesn't prevent excessive risk-taking. It fails precisely when needed most. The catastrophic losses of February 2018, particularly among retail investors who believed they were buying simple, passive products, demonstrated that product design creates systemic vulnerabilities. The lesson isn't that ETFs are inherently dangerous. The lesson is that any structure combining leverage, mechanical rebalancing mandates, and reliance on continuous liquidity contains catastrophic failure modes. These modes activate when calm transitions to stress. The transition is inevitable because calm always ends. The pattern exists because human psychology, financial incentives, and mathematical realities conspire to recreate the same structural conditions repeatedly. Different names, identical mechanics. The snake grows a new head and begins consuming its tail again. Periods of market calm aren't proof of stability. They mask dangerous accumulations of leveraged exposure and behavioral convergence. The VIX reaching 9.14 in November 2017 wasn't evidence that volatility had been tamed. It was evidence that an explosion was building. Current conditions in 2025 match the early warning signals. Record margin debt, extreme concentration in high leverage derivatives, structural mismatches between product liquidity and underlying asset liquidity, widespread belief that this time is different, that modern markets have evolved beyond historical failure modes. The pattern says otherwise. Stage 1 and Stage 2 are complete. Stage 3 is building. The feedback trigger will arrive. It always does.